Hello and welcome everyone. So now we are going to discuss another concept which is very important, that is money multiplier. Money multiplier also is represented as small m, is just what it is represented at. A money multiplier is money supply divided by base money or the high powered money. So this multiplier will be how many times this money supply is to the base money. Okay, so money multiplier explains how initial money leads to multiple deposits. So banking system plays a key role in credit creation. So here comes the role of banks, commercial banks, who engage in accepting deposit, granting the credit further, so that creates the money supply in the economy. So this is the basic formula for calculating the money supply. So as I was discussing, we started with the example of 100 rupees, and out of that, so 100 rupees, and out of that certain reserves are kept with the banks, and then after rest of the money is given as a credit. So 10% is kept, 90 is given, and then 9 is kept, 81 is given, like that they keep on going and be add up, reach at something value which will be, say for example, if this total goes to 500, if this total goes to, let's assume that it goes to 500, then what is multiplier? How much multiple is 500 of 100? So 100 into 5 is equal to 500. So this is the multiplier. Multiplier is 5 in this case, if we assume that total money is created is 500. So the basic formula is M, that is money multiplier, is 1 upon RR. So RR stands for the reserve or the required reserves. So the money supply is nothing but the monetary base or the high powered money multiplied by this M, we reach at money supply or total money supply. So now you will be wondering that the central bank is not creating the whole money which is available in the economy. It is also impacted by the process of credit creation, and that leads to the ultimate amount of money supply in the economy. So let's have a numerical here. So if the reserve requirement is 10% and monetary base is 100, so monetary base money created by the central bank. Now if then in that case we need to find out the M. So M we know 1 upon RR, so 1 upon 0.10, so M is 10. So if the base money is 100 crores, we multiply with the multiplier, that is 10, and we are getting 1000 crores. So this is how 100 crores is changing into 1000 crores through the power of multiplier here. Process of credit creation, I just discussed. Central bank inject 100, then banks keep 10 as a reserve, then 90 is lent out, then this process keep on going, and ultimately we end up with a higher amount of this. Now this is the extended formula of money multiplier. Here we have extended the formula, or this is the extended formula. In the earlier formula we make certain assumptions. So I will discuss how we reach at this formula. So we know that this high powered money, that is this money supply is equal to currency plus deposits, that is the result, because the currency and the deposits ultimately create the money supply, and H is the high powered money, that is currency plus reserves. So it includes currency plus reserves. So reserves are further, there are different types of reserves, are a required reserve and plus extra reserves are there. So reserves are, R is made of required reserve and extra reserve. So if we put here H is equal to currency plus required reserve plus extra reserve, so this is H. So now all these terms, currency with the public or currency in circulation, required reserve, extra reserve, all these are in proportion to the deposits. So how much is the proportion to the deposit? So we can mention it currency as a proportion of deposit. So currency in as a proportion of deposit, required reserves also as a proportion of deposits, and excess reserves also as a proportion of extra reserve or excess reserves are also proportion to the proportion to the deposits. So now if that is the case, then we can fill these values here in case of this formula, extended formula. So H is equal to C into D plus RR becomes RR into D, proportion of D, plus ER becomes the proportion of also D. So this is the H, and if we fill the value of this thing here in M, so M will become M is equal to C D plus D. So now further M is equal to 1 plus C into D. So if the money multiplier formula is M upon H, so we know what is M. M is equal to 1 plus C into D upon what is H. H is here C into D plus RR into D plus ER into D. So this is the thing. So further if we go, then this becomes as 1 plus C into D upon C plus RR plus ER, that is excess reserve into D. So D and D cancelled, it becomes 1 plus C upon C plus RR plus ER, that is the multiplier. So this is how we got this formula. We extend it and we are reducing it to M is equal to 1 upon RR. So we are making certain assumption. We are assuming that there is no currency with the public, held with the public, and there are no extra reserves here, extra reserve with the banking sector. They are lending out all the money which they have, and people are not keeping money with them, they are depositing in the banking system. So once again it is in the circulation. So that's why we are assuming these things are not existing. So that's why M is becoming 1 upon RR. So, a factor affecting the money multiplier. So what are the factors that will impact how much money supply will be there? So there are these 4 key factors: reserve requirements, how much reserves are required. The central banks control these things, that whether how much money they need to keep as a reserve with themselves or with the central banks. So and the other thing is that apart from this, so that will impact the money multiplier. So if say for example 1 upon RR is, earlier it was 1 upon 0.10, if it is increasing to 1 upon 0.12, that means the multiplier's value is going to fall further. As the reserve is going to increase, the M value is going to fall. If reserve value is going to go down, say for example it is reaching 1.05, relatively this value will be higher. So as the reserve requirements are changed by the central banks, that will lead to how much money supply will be ultimately. So that's why I was saying that it is central bank is having indirect control over the money supply, ultimate money supply in the economy. Then next is public preferences for cash. So it depends that how much currency publics want to hold. So this factor is impacted how the economy is performing, whether people are preferring keeping more cash with them or they want to invest and like that. So if more money is coming to the banking system, it will be circulated in the economy, more money will be created. If people are holding more cash, investing less, then that money won't come into the channelization and the money creation will be less. Next very important topic or important this element, that is banks' willingness to lend. So whether the banks are willing to lend or not, because the money supply will be created if the banks are lending money further and further, then only the credit will be created. So if the banks are not lending, I'm not getting into the reasons because that we are going to discuss in this. So if they are lending less money will be created, and ultimately this is the factor which is going to impact all these factors, that is economic condition. If economic conditions are good, then the economy needs more liquidity. So if more liquidity is required, the central bank will reduce these reserve requirements and they will try to inject more liquidity. Although there are other ways through which central banks can increase the liquidity, this is a process through which through the reserves they can do that. Next is public preferences. So if when the public will be wanting to keep less cash, when they find it worth investing. So if they are finding it, then they won't be holding or keeping more money with them. Banks' willingness to lend also impacted by the economic condition. If economic condition is good, those investors who are going to get money or borrowing money, they will be able to repay back. So banks will be happy to lend to them. So in that case, that means ultimately the economic condition is also going to impact, or is the most significant factor that will impact the size of money created in the economy, or how much volume of the money will be there. There are some limitation of money multiplier because of we assume certain things when we try to understand the multiplier. It assumes that full lending by banks are lending whatever they are depositing, which generally doesn't happen, but we can run models where we are assuming that certain amount of money is kept with the banks itself. Then it ignores the risk and uncertainty in the economy, so it is not assuming that any kind of risk or uncertainty is there, and this multiplier won't be able to tell us the true picture of money creation when there is a kind of stressful situation like financial crisis. That time money multiplier won't be giving you the information correctly. Then the central banks control is indirect. In this case, as I said, central bank is not directly controlling it, but through reserve requirements, through other ways, it impacts the money multiplier in the economy. Okay, with this we end this discussion. In the next video we will discuss monetary policy and objectives. Thank you.